Thank you everyone for joining us today. We'll begin the presentation. To begin, welcome everyone to the Cnpp webinar series. The Community Navigator Pilot Program run by the Small Business Administration is a program that was created to serve and to help the small businesses recover from the pandemic and the downturn and the turbulent economy landscape. Um, the COVID, to begin, let's give you an introduction of the program. And so that way you understand what the Community Navigator Pilot Program is. The Small Business Administration, the SBA created the Cnpp as an American Rescue Plan initiative designed to reduce barriers that underrepresented and underserved small businesses owner, such as people of color, veterans, and women face in accessing critical support. Our mission is to connect socioeconomically disadvantaged small businesses with capital for key business improvements and recovery, and to provide businesses with professional counseling to enhance their infrastructure and performance. The USPAACC, Asian American Chambers of Commerce, USPAACC, is one of the 8 national hubs selected by the Small Business Administration to provide support and to provide support to socioeconomically disadvantaged business owners. The USPAACC choose universal processing as one of the national spoke to promote the Cnpp in the Asian business community. And here, universal processing, we are conducting community outreach through grassroots and telemarketing efforts and other channels. Before we dive into the content of the webinar, we would like to complete a brief pre-workshop survey to assess your knowledge before discussing the content. So in the Windows chat in this particular meeting, you will find a link to the survey that you can use to access the survey and complete it. As we access the survey, let's go by the read the questions so that everybody understands what is being asked. So the first question, I can describe why cash flow management is a critically important component of small business ownership. So basically here you will give an answer whether you strongly agree or disagree or strongly disagree. The following question asks whether or not you know how to evaluate, how to assess cash flow cycle in your business and make some cash flow projections. If you feel that you know how to do this, you can select strongly agree. But if you feel that you don't know how to do this, you can select strongly disagree in that particular scale. You can use the same scale also to answer the question. I can describe how a cash flow statement can help assess and improve the financial health of my business. The following question, I can identify at least 2 ways to manage cash flow in terms of managing costs and potential income. And the following question, who invited you to this training? Please write the person's name. We will allow 1 more minute and then we will move to the following portion of the webinar. Wonderful. So to dive in, let's discuss briefly the agenda, the topics that we will be discussing. First, we will review the learning objectives of the program. We will have a brief introduction, and then we will use a particular case study, which is Bob and the Wire Cup, as a particular case study for us to learn these concepts and to apply this concept immediately so that you can have a practical learning experience today. It's super important that you are fully engaged and that you do the exercises with us, as at the end of this particular webinar, there will be an evaluation form that you are required to take so that we can assess and measure your learning attainment. The other topics include the 3 views of cash flow, what Bob can do, which is bought from the wire cup, and a couple of options that we will discuss based on the scenario given and provided. And then at the end, we will do a summary post evaluation as mentioned. So the first learning objective is you will be able to describe the purpose of the cash flow management in any small business and especially startups. The other learning objective is you will have a broad understanding of how you can evaluate a cash flow cycle and make cash flow projections. We will use practical examples that you could apply immediately, and we will discuss those as well. We will also be able to describe how a cash flow statement can help you assess and improve the financial health of your business. We will also work in this particular case to identify ways to manage cash flow in terms of managing costs and potential income. So means potential revenue, potential sales. And lastly, we will review and identify ways to seek out expert technical assistance to improve cash flow management and for other business-related topics. So let's begin to introduce the Bob and the wire cup. And this is a realistic example that we will use, as mentioned earlier, to review how cash flow management decisions are taken. As we review both cash flow issues, you might find that these concepts relate to your own cash flows questions. And it's super important that if you discover that there are certain things that we are discussing that relates to you, please take notes so that way you can come back to these notes and review and apply the knowledge acquired today for your particular case. But recently opened a new bakery cafe, the Wire Cup. The cafe has a great location in a small college town. To get started, Bud invested $30,000 of his own money and received $20,000 in a loan from a commercial bank. He spent $45,000 on starting up the business. So he uses this money to acquire inventory, to get machinery and equipment, and for other business setup. He has left about $5,000 to run the business for the first few months. The Wire Cup is already popular among students and university staff members and neighbors. Everyone loves the coffee and baked goods. A college dean has started to order croissants for the faculty dining hall, and Bud is building a great business. So this is awesome. Although Bob is super happy with the beginning of his business and everybody is welcoming the services and products that he's offering, he has some concerns. He has not paid himself yet, and he wonders when he can actually do that. This is a question always in the mind of a recent business owner. And one of the main concerns that Bob has is that the $5,000 that he has left from the startup budget is almost gone based on expenses for the business. So given that these kids' customers are students, and he assumes that many will go home over the holiday breaks and the summer, so Bob has some questions. The questions that he has is how he will pay his bills with fewer customers during those particular seasons where there will not be students or staff on campus. Will he have enough money to ramp up again in September after the summer? And should he buy in bulk to reduce costs? Another question that he has, which is super important, will suppliers allow Bob to buy on credit? And does he still have to pay cash? These are good news because Bob is thinking ahead. He is taking steps to resolve the issues. He is resolving, he's being proactive about the situation, and he has the right questions. So now let's discuss a little bit more about the continuum of cash flow. So before we dive into both a case study, I would like to know where do you feel that you are in the cash flow continuum? You feel that you are a beginner, or you are intermediate, where you know certain procedures for cash flow management decisions, or whether you feel that you are an expert and still have some questions. So if I will allow a couple of seconds so that if anyone wants to share their expertise or knowledge. And this is something super important, because the how practical is exercises that we will do today is something that you will be able to apply to your business, as we will be providing you with templates so that you can use the templates to create your cash flow statement and test the knowledge that we are sharing with you today. So to begin, let's review the opening balance sheet for the Wire Cup. Please go to page number 5 of your participant guide so that you can review this more closely. I don't know if the resolution allows you to read it clearly on the screen, but if you can see it clearly on the presentation, please open your participant guide so that way you can follow along. So let's begin to review the balance sheet. This balance sheet lists pre-opening expenses as current assets. In this example, the pre-opening expenses listed were expenses or realized before the end of the year. Interpreters should always keep track of pre-opening expenses, as some may or might not be considered by financial institutions or investors as a business asset or owner's investment or equity. Super important that you keep this track of this if you are a new business. This openings balance sheet tells a story: how much money Bob had to start his business, how he financed it, what he did with that money, and how much was left over to run the business. So basically, a balance sheet is a particular accounting tool that tells you that describe the business assets, that describe the business liabilities. And these are concepts that we'll review here so that you feel comfortable. And before I move forward, I will briefly discuss these concepts. So assets are any property or anything that the company currently owns. So for example, fixed assets are expensive items that last, such as buildings, upgrades, space, vehicle, equipment, computers, any type of fixed assets that has a fixed value that is subject to depreciation, and I will discuss depreciation in a few, are considered for fixed assets. What do you consider current assets? Current assets, you can consider all of the other items that the company owns, like inventory, like account receivable, that is money that the particular merchant has in his account receivable. It also includes all of the other categories for expenses. So those are the current assets of the particular business. So liabilities, you can think of liabilities in terms of debt and obligations that the merchant has. So these are basically money that can be translated in money that has to go out of the system, out of your cash flow cycle. And just to give you a very brief description of how you can interpret this. So to move forward and evaluating the opening balance sheet for the Wire Cup, the balance sheet tells us that Bud invested $30,000 of his own money. so owner's equity. This is his equity because he invested that money, and that he borrowed about $20,000. The loan is over 5 years with a 14.54% interest rate. In year one, Bud will pay back $3,371 of principal and will pay the remaining balance of $16,629 in years 2 through 5. So this is the assumptions that we were given at the beginning of the case study. It's good that it will be useful for you to take notes and to highlight it in your participant guide, as this will be information that we will use to make decisions in the rest of the webinar. Let's discuss a few notes about that. So it takes an effort to obtain a small business loan. We are discussing this because Bob had to obtain a business loan to open his business. And there are multiple options available out there that can help you. And the Small Business Administration, in conjunction with other organizations, have different programs. And just to mention a few, there are microloans. Microloans are loans that that merchants can apply for less than $50,000. These type of loans usually do not require collateral. It just depends on your business plan, your cash flow statement, and your open balance sheet. So it's super important that when you apply for a business loan, especially a startup, that you have a business plan. This particular webinar series, we do have a particular module that provides information about how to prepare a business plan and how to prepare for a healthy business. And I believe that is the topic for the month of December. So put it in your calendars, but however, we will let you know once we have that training in a schedule. Another loan that is super common is 7A. 7A could be for other type of, for similar situations, but that the money will be invested in fixed assets, or usually for property, or for tangible assets. And that could be for any amount above $50,000. And it could range all the way in the $100,000. And you could use it for this particular purpose. And if you basically are in need of the money to acquire some real estate in order for you to open your business, or any other similar purpose. It could also be acquired for the purpose of upgrades, or major modifications in your business. So your credit score will directly influence your ability to secure a loan. So if if you are new, if you are a recent business owner, so most likely, like what the credit score that will be used for the loan will be your personal credit score. Now, if your business has been operating for a certain time, for more than 3 years, and the legal entity has, which is whether it's an LLC or a corporation or a sole proprietor structure, you will be able to apply for the loan with this particular structure. So some of the steps that you can take in order to apply for a loan is talk to a bank's commercial loans officer before you need the loan. And here, through the Community Navigator Pilot Program, we have extensive support and services that we extend to our merchants. And they are free of cost. We can connect you with SBDC officers and SBA officers and other experts in the area that can help you with funding opportunities and help you prepare for those particular matters. As mentioned earlier, there are other modules in this webinar series that we will be presenting in the following months that you could use to prepare yourself and prepare your business for these particular matters. So returning to the balance sheet, and please turn to page number 6 in your participant guide. If you just joined the webinar, you can find the link to the participant guide on the meeting chat. And please turn to that page so that we can continue to review. So back to the opening balance sheet. In total, Bob had $50,000 to spend to open the wire cup. He spent $45,000 on equipment, materials, and other assets as indicated on the balance sheet. So they are $29,500 in fixed access and $15,500 in current access for a total of $45,000. He had $5,000 in cash in remaining balance to run his business. If I were Bob's lender, a potential business partner, or a vendor, I will look at his open balance sheet and ask the following questions. Has he invested enough money of his own money in his venture? Did he finance the business wisely? For instance, does he carry too much debt? The terms and the time requirements for the loan repayment can make a huge impact on cash flow, especially because those obligations do not go away, and usually you cannot renegotiate those particular terms. So those are obligations that Bob's must meet in the following 5 years. Did he wisely spend the $50,000? Is there enough available cash left over to run the business? Is $5,000 enough to carry him through a 6-month period? And these are questions that we are basically establishing that we will be able to answer with the cash flow statement. And we will discuss briefly the particular cycles. So there are a couple of cycles that we have to take into consideration to understand the cash flow statement. First is the cash conversion cycle, the cash flow diagram, and the cash flow statement. So the cash flow cycle tells us a different story. And this is for us to have a quick idea of the money that is put into the system, that is transformed into services and products, and for us to provide products and services. And then that allows us to convert those particular assets into money back into the system. And this is the cash conversion cycle. So a business pays for raw materials. In order for us you can consider raw material supplies, inventory, all of the things that are needed for you to be able to provide the services, and including labor as well, including overhead, like including rent. All of those things are money that we are putting into the system, into the cash conversion cycle. And then business is able to use all of these components to make products or design services. And we determine when these services are going to be provided to who and how. And then when we convert that into business, into products of our own, or into services that we provide through our business, then customer pay for those products and services, and then we convert those assets into money that goes back into the system. And we will review briefly another diagram that will have a more a broad perspective. Let's dive into the cash flow diagram. And this is super important that we carefully review this diagram. And as you can see, the sales pump is at the top left corner. And you have basically a current of the money that comes in from customers through sales. and you see it another current that comes up with resources from lenders that could be investors as well. And it's super important that we have this in mind, because these are the currents into the system, how the money enters the system. And then gradually we see how we provide credit to our customers. If we provide any services or products in credit terms, that will increase our cash in our account receivable. And account receivable is any money that our customers own us for services and products that we provided. And usually these type of credit terms are in 30 days. You can always discuss this with your clients, and a good practice is to provide certain incentives. If you want to provide services in credit terms, you can tell your customers, especially in this particular case, that Bob is providing croissants to one of the dean's hall in the university. So he could as well provide the services and products in credit terms and give some type of incentives. If the invoice are paid within 10 business days or within 15 business days, he could give them a discount of 1 or 2, 4, 5%, whatever he feels that is within a markup price that he can that still will be profitable for his business. And if that shorten the time frame in which he will be repaid for the services helps, then he could make that decision and provide that incentive to customers to pay in advance. Another way to look at this is looking at your central tank. Your central tank is where you have your available cash. And all of your available cash, and this is super important that business owner must understand that it's super important to have separate business accounts. So your business account, your checking business account should all only be devoted for that particular matter for your business. And you should have a separate business account for tax purposes where you deposit the daily collection of sales taxes so that you don't mix your available cash with cash that you're collecting for the government. And we will discuss this briefly so that you have a better understanding of this suggestion. But from the central cash available, you have all of your expenses where you pay for labor, materials, and for you to basically replenish the system so that you can continue to provide services and products. So let's go back to the cash flow statement of the Wirecard. Let's begin to discuss the cash flow. So please go to page number 10 on your participant guide. I will allow a few seconds so that you can turn to that page 10 in your participant guide. And if this is located in the meeting chat window. Perfect. So the statement tells a story. So the statement tells how much money Bob has to run his business, how much money is moving in and out of the Wirecard, where the money is coming from and where it is going, and when that money is moving in and moving out of the business. So it is super challenging sometimes to balance accounts payable and account receivable, and this is something that you need to keep in mind to keep the balance in your business, because you want to keep the balance of the cash coming in. You don't want to have a short conversion cycle a long conversion cycle where the money takes too long to be converted back into. And this is something that you want to take into consideration, because with the cash flow statement, you can do projections and determine how much inventory you need for a particular period of time. For example, if you are a coffee shop or a business within the food and accommodation services, You don't want to have items in your inventory that could expire, because that will basically be a loss at some point if you don't provide services or products that need those raw materials within the life cycle of those products or raw materials. That could be a loss for your business. So you want to have all this in mind. You don't want to have too much inventory. You don't want to have short inventory, because if you have short inventory, then you cannot provide services and products. So this is a gains number. So you basically have to play with your numbers and see where does it fall, and that's what the cash flow statement is. So once you are in your particular participant guide, let's begin to discuss the cash flow statement. So as you could see, Bob used the first 2 months that were actual business operations for him to project the following months. So he opened in August, and he used his knowledge in August and in September as well to determine the projection for the following months. He was able to observe that he had a sales revenue of $25,000. He was able to observe that he had a revenue of $27,000 on the following month. So then he used the average between August and September to run a projection based on when he thought that he was going to have more customers. As you can see, in September, October, and November, he projected an increase, taking into consideration that the students were attending classes and that there were going to be a higher traffic. He also, conversely, reduced the projection during the month of December because of the holidays. And he gradually increased it in January, February, March, and April, taking into consideration that that was an active semester. So it's super important that you take into consideration seasons. And at the beginning, that can be a little bit challenging if you are new in that particular field, but you can use the knowledge and experiences of other merchants as well in the area or in other areas for you to make determination. So it's super important if you can to belong to certain associations where you can do some networking and learn from what others are doing in your field. Then he also acknowledged that during the month of June and July, he will have a very short sales revenue, and he's projecting at $20,000 for the summer, but he's not sure yet because he opened in August. So this will be the first time that he's open during the summer, especially those 2 months at the beginning of the summer. So if you have some control over how cash flows in and out of your business, for example, the sales you decide that will sell, where, to whom, how, and at what price, the same goes for expenses. You can decide what space to lease, how much debt to carry, when to advertise, when and how much raw materials to purchase, and how many staff to employ. And this is super important, because if you believe that, for example, during the months of the summer, he will have a decrease in the clientele, he can reduce the hours of his employees accordingly and work from there so that he can position himself. He can also reduce the inventory gradually from the month of May towards the month of June, taking into consideration that he's projecting a decrease in sales from all the way from April all the way to July. If you notice, in April he's projecting $32,000, and in May he's projecting $27,000 in sales, and then June and July he's projecting $20,000 in sales. So if that is the case, he gradually has to become aware that he has to gradually adjust his inventory from April towards the end of April all the way through May, because he has significant decrease in projected sales. And other things that he can consider, he has to consider, for example, the how much money he has available in cash. Of $31,000, for example, and cash flows of $29,000. So basically that conversion, it tells you how much cash you have available. And if you pay attention at the bottom of the cash flow statement, the amount that is available for those months, the cash that is available for those 2 months is $2,309. So this is way less than he has available at the beginning of the cycle. So that these are super important questions that he asked. And now with the cash flow statement, he has a better understanding where he will be positioned in the following months. And now he has some time to prepare for it. If you go to column number at the beginning of the section, which is in August, that's where you can see that available in cash. And there are some concerns in the cash flow statement. If you go to the month of July, based on the projections, he has a negative projection of $4,316. So this means that he will be charged $4,316 in the month of July. He will need to resolve that before then, and he will have to make certain adjustments so that he can proactively avoid that negative number in his cash flow statement. And certain things that he can do, we will discuss in the following section of the webinar. So just to summarize what we have discussed, Bud is happy. The wire cup is doing well, but he's worried about the rest of the year. He projects he will be able to pay all of his financial obligations, but he will be cutting it too close, and he has certain concerns. It's super important that you consider that when you do projections, that you do not overestimate revenue. Overestimating revenue can put you in a situation where your expenses can be higher than your revenue, and that can definitely affect your business operations. In a good practice for this is to create different cash flow projections. You can create one in the best case scenario. You can create another one, the worst case scenario. And that way you have two options. If things are going well, you know where you will be positioned. But if things start going bad, then you know where you're going to be positioned, what you need to do. That's what proactive thinking is. So for example, if Bob creates a cash flow statement with the worst scenario, where he is having some negative numbers towards the end of the projection, then he has to take action to decrease his costs and increase his revenue. So that's the basic activity that he has to do, but there are a lot of other items, a lot of other steps that needs to take place in order for Bob to be able to resolve this. So what can Bud do? How can Bud increase sales revenue at the wire cup? How could Bob negotiate a better deal with his vendors and suppliers? How can Bob plan for seasonal ups and downs? Is it wise for Bob to use a credit card to offset cash flow issues? What do you recommend? So I will allow a couple of, basically about 8 minutes so that you can quickly brainstorm on these questions, and then we will do some type of activity together to answer these questions. Just to remind you, you can find this particular section on page 11 of the participant guide. If you just recently joined the session, you can find the participant guide in the meeting chat window. And please go to page 11. Okay, great. Let's discuss a few ideas for Bob. So note that some ideas that you suggested that probably might be on this particular slide. So good job if you thought about these particular ideas. So let's discuss them briefly so that we have a better understanding about what this entails. Bot can increase the flow of revenue into his business. How he can do this? How he can increase the flow of revenue into his business? He can provide incentives to his customers for to pay in cash. And this is some strategies that we briefly discussed today, that he can also provide some incentive to those particular clients that he provides services in credit terms. He can start catering. That's another option. He can do some catering from outside the campus or to advertise it in other areas, since catering is a bulk order, and he's just going to have to work with the logistics cost to provide the service at another geographic location. He can also start selling gift cards so that when people return to campus can use those gift cards. That's some promotions that he can do. And he can work with different avenues to obtain marketing strategies or marketing ideas on who he can target and who his audience can be. So Bob also can reduce his outflow, perhaps by making some arrangements with vendors or his landlord. Bob can modify the way that the way that he paid rents and all the terms for his lease. So certain things that he can do, he can increase the total amount of that he pays monthly during the month that his business is doing well. So let's say, for example, during those 2 months, June and July, he will not have that much student on campus. He can divide the rent by 12 months and multiply by 10. And during the month that he will be making profits and that his business will be healthy and with a strong cash flow, he can pay for rent during those 10 months. And then that will allow him to pay in full the rent during those 10 months, so that June and July, he has less expenses to pay. Another thing that Bob can do, he might cut back when he expects business to slow down. Perhaps he can reduce the hours of his staff members, or he can cut down certain items in the menu. And by taking some items out of the menu that are usually not sold when there are not that many students around, he can control his inventory and the amount of money that he spent in inventory. And this is a super question, because even large corporations struggle with this, and that's why they have a supply chain management in place, so that they can determine by analytics how much inventory they need in a specific time frame, in a specific period, so that they can have that inventory estimated, so that they can avoid in overspending in inventory and having loss. And this is super important when you are basically in the restaurant industry. You do not want to have a large inventory that you will not be able to convert in a short cycle. Many of your items can perish, and this can become a loss for your business. So it's super important that you estimate your inventory accurately and that you use your cash flow projections so that you can have a better understanding of how much money you should have in inventory. Um, I know that this sounds a little bit complicated, but this is super simple. Many of small businesses have already in place structures that allow for you to have all these financial management techniques in place. Many of you have access to a point of sale systems. Point of sale system usually include reporting capabilities for you to have inventory management or sales tax sales reporting functions and etc. So if you do have a point of sale system that is able to do inventory management, it's super important that you understand how to use it so that you can use it to have your inventory updated at any given time, so that you know how much money you have in inventory in any part of your cash conversion cycle. And this will allow you to make decisions accordingly and to make more effective and efficient decisions. So another thing that he can do is he can negotiate with vendors and suppliers. What he can do, he can negotiate the payment terms. Usually payment terms are within 30 days of the purchase. But if he is able to renegotiate this with his suppliers, maybe perhaps he can get an extension of 10 days, or maybe he can get a discount if he pays portion of the invoices earlier. There are different things that he can do to decrease the cost in inventory by renegotiating with suppliers or of vendors, or postponing or making payment arrangements in a certain period so that he can prolong the time in which he has to repay for those assets. So what not to do? What it is not advised for Bob to do? Do not postpone paying estimated taxes. Do not hide from loan officers. They can provide invaluable advice. Do not pay vendors late. They can cut off supply. You do not want to do that, and you don't want to also run your credit. Do not overestimate revenue. You don't want to be in a situation where you feel that you will be getting $15,000 in sales revenue when you know by the data that you have available that could be way less, that could be $30,000, because if you do so, then you will be overestimating and you will be in a lot of issues. And equally, you do not want to underestimate your costs. You need to have a list of all the obligations that you have, and that list must include all of your expenses. And this is super practical to have these centralized. So there are certain systems in place that you can have to have efficient management tools. If you need help with these particular topics, we do have merchant consultants that you can consult with them, and we can pair you with experts in the field to give you, to provide you with the specific tools needed for you to embark on effective financial management. As I mentioned earlier, it is super important that you also set up a separate business account for the collection of taxes. Never use your sales taxes as a financing option. Some business owners use sales tax in a cash crunch, hoping they will replace the tax when things look up. This is very risky, and we do not recommend it. Penalties are high for not paying taxes on time. So it's super important that you have a separate account to set up your sales taxes on the side every day. And also, just it's good to highlight this, your point of sale system has reporting capabilities, reporting functions that tells you daily how much money and tax you have collected. So you can use these reports to conversely source the information for your cash flow statement and for your financial management techniques. It is professional to ask for help. So asking for help does not mean that you do not know what you're doing. It means that you know what you're doing and that you know that where you actually need professional help, where you need someone to give you, someone with professional expertise to give you an advice. So seek out expert technical assistance. An accountant can help you find ways to increase income and reduce expenditure. But it's super important that you understand that this is not a sign of weakness. We can also help you to find technical support from the SBDC or SCORE, which is the Small Business Development Centers, who can explain cash flow in ways that relate the concepts you that for your own business. So key points to remember. Managing cash flow is a core competency of a small businesses ownership. So this is something you need to do. This is something you need to grasp, that you need to understand. Today, this is a really useful introduction, but we strongly recommend you to review the study, the participant guide that we provided you with today, to provide you with, to also study this particular presentation, which we are sharing with you after the webinar, and to continue your study so that you get better at your cash flow management strategies. In openings balance sheet tells you a compelling story. It's super important that you know your balance sheet, your most current balance sheet, and this is something you can get from your accountant. A cash flow statement continues the story. Use it to monitor projected and actual income and expenses. This is something that you need to review and modify in a daily basis, and that you review on a monthly basis, so that way you can see your progress and whether or not your projection were accurate and how accurate your projections were. Plan for seasonal fluctuations. Your revenue can fluctuate based on the season. So take notes when these fluctuations take place, so that way you can use this information in the future to make better decisions. Try to maintain a rapid cash flow conversion cycle. Please remember, buy the inventory that you need, that you know that will be converted in a reasonable time. Do not overspend in inventory that will be sitting there for months and will have your cash sitting there, also exposed to risk, especially in those businesses that are restaurants or food services, where items can perish, expire in a specific cycle, which can create loss for your business. You don't want to waste money. You don't want to waste resources. Manage your paperwork like a pro. Do your business day-to-day operations. Use your reporting capabilities and your point of sale systems to run reports. Write your daily sales revenue, write your daily sales taxes, so that way you can definitely keep track of, in a daily basis, of your obligations and your stream of revenue in. And that will help you at the end of the month to put together your cash flow statement and to adjust the projection for the following months. And please remember to ask for an accountant for advice. It is super important that you have an accountant, and that an accountant is providing you with services to put together your income statement and your balance sheet. These are items that should be readily accessible to you. There you go. So we have arrived to the post-training evaluation portion of the webinar. So at this moment, we are dropping a link to the post-training evaluation to assess your knowledge on this topic. This evaluation only takes approximately 2 to 5 minutes. We will allow a short time so that you can get it complete, and we will move into the next survey, which is a post-training survey, which is shorter. This is feedback that we are collecting for our future webinars.